Society traders, as I've been requested by many of you to look into the concept of market structure and how I understand market structure and how I apply market structure in my trading. Number one, I'll be looking into support and resistance and the essential of market structure, time frame, and I will break down a few things and I will take you through the model and we'll go through the charts. So this is a frame of support and resistance. Some of you are familiar with support and resistance. So what is happening on support? It's an area where demand exceeds supply, and the resistance is an area where supply exceeds demand. A support area, we are looking for buying opportunities. In a resistance area, we are looking for selling opportunities. So when a resistance is broken, it turns into a support level. It supports price, it pushes price up. So this is just the basics of support and resistance. And when a resistance is broken, it turns to support, and when a support is broken, it turns into a resistance. So it's just a framework. As you can see, resistance being taken out, retested, and it turned into a support. As price visits this support, it pushes up. So this is just a basics of support and resistance. So all your trades should be framed on support and resistance. You should understand the basics of support and resistance. Every time when you're trading, you need to have support and resistance marked on a higher time frame. You mark your support and your resistance. This will also give you an indication where to have your buyers and where to have your draw on liquidity. For example, if you are long, your draw on liquidity will be an area of resistance, and if you are short, your draw on liquidity will be an area of support. So this is just a basis of support and resistance. What we are seeing here, it is a frame of price anticipation. So when you are looking into market structure, you are having a framework of price which is like this. So what we are seeing here, you'll see price accumulating in this area and expanding to the upside towards an area of interest, which is your resistance or your supply, those who are trading supply. So price will be moving from here to an area of interest, and this area is framed on higher time frames. The highest time frame, this is where you want to mark your resistance. For example, if you are trading the daily chart as your highest time frame from the 3 time frame that you are trading, so this area will be marked in your daily chart. So you have this area here as your gray area. You don't know what will happen here, and you don't know if price is going to move here, but you are anticipating that if the move is continuing to the upside towards your resistance or your highest level or your key area where you are anticipating to take your trade on. There might be opportunities that are presented by price here and also here. But at this moment in time, but you want to see price taking out resistance areas, breaking structure, and maintaining support while it is moving towards the key level. That's what you want to see. If you are taking trades here or you are long here towards the key area as a draw on liquidity, you want to take trades as when price pull back using your own signal entries, Judas, fair value gap, order block, whatever type of structure that you are using for your entry. But what you have framed your trades on is seeing price breaking highs and maintaining lows. And also here, there can be opportunities that are presented. Sometimes you will leave these opportunities and wait to take your trades on your key level, that is where you are anticipating the move. But as I said, you don't know what's going to happen here. It's your gray area. It's just an anticipation, it's just a plan towards the key level. But as when you see price taking out highs and maintaining lows, it means that the move is going up. Sometimes price will pull back down and take out the sell stops, moving back higher, taking out the highs, proceeding with them. You need to be comfortable with that. As when price take out the sell stops, it is not a reversal. No, it is just a clearing of lows to seek liquidity and expanding to the upside. So as when price reach an area of interest, the key level, when price is here, what do you want to see? When price approaches a key level or key resistance, you don't look to buy. You are not expecting a breakout in that area because it's an area of liquidity. What are you expecting in this area? You're expecting price to hold on this area, and you're only looking for sell opportunities. But there are fundamental principles which should back up your anticipation on this key level. Number one, you want to see a break in market structure as you see price breaking this low and establishing a high. This high, it can be a long-term high, while these ones, they become your intermediate highs. And this low, the intermediate low, you want to see this low being taken out. And when this low is taken out, this is it's enough signal. When this low is taken out, it's enough signal for you to tell you that there's a shift in market. There's a shift in the trend. It means that the bullish trend, it has changed now. There's a reversal in the market. The trend has changed. From here, you were anticipating a move to the downside now. So what will happen is you take out the low and there will be a mitigation or a pullback. And when price is pulling back, this is where you are looking to take a trade. The signal entry can be a fair value gap, an order block, or a buy side liquidity area. Sometimes it can take out the low and move up to take out the high before expand to the downside. So here it's also your gray area and also a gray area. You don't know what is going to happen here. You don't know what is going to happen here. But you have an anticipation of a move to the downside. And your move to the downside, it is influenced by a draw on liquidity. What gives strength to your buyers, it is an area that pulls price down. This area acts as a magnet. This can be this low as a draw on liquidity, or it can be this low as a draw on liquidity. So you're anticipating a move to the downside. So you're anticipating a move to the downside. You don't know what's going to happen here on this area. But as profit is presented when you are here, you can also take some profit. And a move to the downside also, you can take some profit. Sometimes it can come here and pull back up and take you out with a deep pullback. Sometimes it can just continue to breaking out, taking out lows. But as when it's taking out lows, you are taking out of profits or you are trailing the trade. So to the downside, you have a draw on liquidity frame, which is your projection. So this is just a framework of what you should have in mind. Same thing when you're bullish, it's just an upside of this. And so this will act as your accumulation, your reaccumulation, your distribution, redistribution, redistribution. So this is what you are. So when it distributes here and redistribute on this area, you have your bias in mind and you are following your bias. And in your bias, you have anticipation of what will happen as when price move to the downside. So what you are seeing here is a framework of directional bias. Is what we have talked about, that when price moves to a key area of resistance, you want to see a break in market structure. When this low is taken out, this will become a long-term high and this will become your intermediate high as a pullback. And how do you project your move to the downside? You can project your move to the downside taking from here to this high, and this one you will have it as your projection to the downside. And if this low is taken out, you will then use from here, this point to this point, as your projection from here to the downside. So this is what you want, this is what you are seeing. So when the lows are taken out, even if you see a pullback, you remain with one bias, that you are bearish. Same thing when you are bullish, a break in market structure, return to order block, and then as expansion to the upside. So you see this high being taken out, you remain bullish even when there's a pullback. This high has been taken out by this high. Price pull back deeply, you don't change your bias. This is not a reversal. This is a seek of liquidity to take out people who were long here and clearing out the sell stops. So you remain long, as you can see. So this is a framing of market structure, defining a bullish trend and a bearish trend. Now you have to understand, number two, that when you need to understand the time frame that you are trading as when you are applying this concept. So you will have the highest time frame from the three time frame that you are trading as a time frame where you will establish your bias and where you will mark key areas of support and resistance. If you are trading the daily time frame, the daily time frame will be, as a swing trader, the daily time frame will be as the time frame that you are using to establish your bias to mark support and resistance. The H4 will be used to mark key levels and project areas of take profits and areas of entry. And also you can redefine to the H1 time frame. That's where you would execute the trades. And for intraday, the H4, the H1 and M15, and for scalping, H1, M15 and M5, 5 minutes. And for position trading, it's your monthly, your weekly, and your daily chart. But you can use the daily chart as your framing time frame because that time frame, it presents a lot of opportunities. I've been trading using that time frame, and I've seen that you can have information on that time frame, immediate information, and also an information about a short-term move that you might anticipate. It's a very good time frame that you can use to frame your trades on. Even if you're a day trader, you can use the daily chart, the daily time frame to establish your bias and to also establish to mark up key areas of support and key areas of resistance. So I've also touched into projection of take profit, how you will then project from here to here is the move from this point to this high. You will then take it to give you a profit from here to here, and when this low is taken out, you'll then use the projection from this high to this low and bring it to this entry up to this low. So this will give you your targets. What we are seeing here, it is a framing of market structure, but that I've tried to simplify. So you can see a move towards a key level, towards a key resistance, towards a key high, towards a key area of draw on liquidity, or towards an order block. So as when price move high, you want to see price breaking into this low, giving you enough understanding of what is happening in the current moment, or to validate your bias. As you can see, when price break this low, we mean that there's a shift now in market structure. The bullish trend, it has changed to a bearish trend. Immediately when you see this break in market structure, your mind, it should your bias, you should have a bias in mind that now you are bearish. When you see this happening, you now have a bearish bias in mind because of a shift in market structure. And after this shift in market structure, you don't just enter here because price has broken this low. You wait for price to pull back, before you take your entry. there will be a pullback or a mitigation towards an area of order block, an area of fair value gap, or towards buy side liquidity. And you are going to use that as a signal for entry, depending as to what type of signal you want to see for you to take a trade. So when price pull back up, you have now a bias in mind. And when you take when you take the trade, you should also understand time and theory when to take this trade. When this happens, when there's a break in market structure and there is a mitigation, you then have a price and theory when these things are happening. That's your London and New York kill zones. To the downside, you need to mark an area of magnet, an area of liquidity, an area that pull price, where price is interested to go. We call this a liquidity draw. In this example, this will be a sell side. This is where sell stops are. This is the more liquidity area. This is where the sell stops are. It is called a draw on liquidity. That's where price is going. That's where price is interested to go. This is how you frame your anticipation. So when you are taking the trade, you are projecting your trade towards a draw on liquidity area. So on what we just analyzed, we have to now identify a sell model within that plan. Is there a valid sell model that we can use to reaffirm our bias to the downside? So this sell model will be composed of an accumulation, reaccumulation, a distribution, a redistribution, a distribution also, and a final redistribution on the liquidity, on the draw on liquidity. This final distribution, it can break the low, and there can be also a further move to the downside, but ourselves, we are targeting this low. If you're a day trader, 20 pips below the previous low. If you are a short-term trader, 50 maybe to 70 pips before the low. So depending on the type of trader you are. So this is the model that you want to see. The price going up, breaking market structure, return to order block, and expanding to the downside towards draw on liquidity. So this is the framework. This is the essence to market structure. This is what you want to see. This is the foundation. I'm only talking about the basics of market structure because this is just part one. So you need to have this in your mind. This must be an integral part of you to understand. But the most important thing that you have to master, it is a break in structure. If you understand a break in structure, you will be able to know what is the current trend, where is the market going currently. And you see that by a violation of highs and low. Highs are being constantly taken out, you know that you are in a bullish environment. And if lows are taken out, you know that you are in a bearish environment. That's what you want to see. This is the basis of market structure. We are looking here, it's the GBP JPY is currently on a bearish trend, has a bearish bias, but I will be taking you through to some of the things I was talking about on the theory part. So now we'll be applying the concept now and having a deep understanding of what is happening on market structure. What did you see? Look at this chart and try to spot the things that I was talking about. As you can see, there's a move to the upside, bullish move, and we see it being taken out, and there's a mitigation, a return to other block, and there's an expansion to the downside. As I said, that rule number one, you want to see a break in market structure. So there's a break in market structure. And when there's a break in market structure, you are now bearish. When you see this move, it doesn't mean that it is bullish, or it doesn't mean that things have changed. No, it is returning to order block. When you see this mitigation, you must see it as an opportunity for you to take your trades. Now you want to mark where you are going to take a trade. This is an order block right here. You see, this is an order block. So I will mark the return to order block. So this is a return to order block, and I will mark the return to order block. And after apply the return to order block, see. So I also outlined that there must be a draw on liquidity, which you must also identify when you're framing your trade. Where are you anticipating price to go to? There's a draw on liquidity. This is where you'll be taking your profit. This is where you are targeting price to go. So this is how we framed our trade. You can see now. And I've also spoke about you identify. Let's say this move has not yet happened. You have to identify your sell model. What do you see? You see? Accumulation, reaccumulation, and distribution. While happening on distribution, there's a break in market structure. And the distribution here is where you want to take your trade. This is where you want to take a trade. And this thing, as I've told you, that what time it's happening, what time is it happening? During London and New York key zone. just spoken about price and theory. As you can see, the London session just opened right here. So, and you are taking the trade above the opening price. Above the opening price on London kill zone. This is where you want to sell here. Right here. This is where you're selling. And what is happening? Break in market structure. Right? The break in market structure. You can mark this area. Mark this area here. The break in market structure, move, break test, and the New York pullback. Boom. TP has been hit, and if you want to take a trade 20 pips below the low, just here, but there was a further move to the downside. So you now see the sell model being evident. So this is practical now. The things that I was talking about, you now can see them. How evident it is for you. So if you are trading this concept, as I've said before, that if you want to be good in ICT concepts, you need to pick one or two. In fact, pick one strategy that you are going to trade. If you are trading this concept, breaking market structure, return to order block, you sell. You only look for this. You don't trade other things. You only look for this. If you are going to trade this concept, you can be very, very profitable because it plays out across all other prices. Just like what I was talking about poetry, that it plays out on all assets. Even here, you can also see poetry, opening, manipulation, expansion. What do you see? Poetry evident also. You see? Evident. So this is where you are taking a trade and an expansion to the downside. I hope you guys enjoyed part 1 of market structure. There are other things that I'm still going to talk about, which I didn't touch on this phase. So kindly make sure that you subscribe and you click the notification button so you keep updated on other upcoming episodes that I will be talking about. So it's just a basic of market structure. Wish you all the best on the trading. This is the outside trader bringing to you market structure part 1. Cheers.